Africa is blessed with a contradiction that defies logic. The continent holds 30% of the world's mineral reserves, 60% of the world's uncultivated arable land, and the youngest population on the planet. It's home to some of the fastest-growing economies in recent history. Every decade, economists proclaim that this will be Africa's century. Investment conferences buzz with excitement about untapped markets and demographic dividends. Yet, despite all this promise, despite all this potential, Africa remains the poorest continent on Earth. Why? The answer isn't what most people think. It's not just corruption, though that plays a role. It's not just poor governance, though that's a factor. It's not even colonialism's legacy, though those scars run deep. The real culprit is something more insidious, more systematic, and more devastating: capital leak. Every year, more money flows out of Africa than flows in. The continent isn't poor because it lacks resources or opportunity. It's poor because its wealth is constantly being drained away, like a bucket with a hole in the bottom that no amount of pouring can fill. This is the story of why Africa's growth story keeps failing. It's the story of how the very mechanisms designed to help development are often the same channels through which Africa's wealth disappears. It's a story about the global financial architecture that extracts more from Africa than it contributes, about corporate structures that exploit regulatory gaps, and about a system where Africa works hard, but someone else collects the paycheck. Understanding the capital leak problem isn't just about economics. It's about understanding why one of the world's richest continents in natural resources remains one of its poorest in living standards. Point 1. The illicit financial flows. Money disappearing into thin air. Let's start with the most obvious form of capital leak: illicit financial flows. These are funds that are illegally earned, transferred, or utilized across borders. We're talking about tax evasion, money laundering, corruption proceeds, and trade mispricing. The numbers are staggering and should shock anyone who cares about development. According to multiple studies, Africa loses between $50 billion and $80 billion annually through illicit financial flows. To put that in perspective, that's roughly equal to all the foreign development aid Africa receives each year. Think about that. For every dollar the international community contributes to African development, roughly $1 is being siphoned out illegally. It's like trying to fill a bathtub while someone has pulled the drain plug. The most common method is trade mispricing, also called trade-based money laundering. Here's how it works. A company exports minerals from an African country, but deliberately undervalues the shipment on paper. They sell $10 million worth of gold, but declare it as $2 million in export documents. The difference, $8 million, simply disappears from the African economy, reappearing in offshore accounts or foreign subsidiaries. The same trick works in reverse with imports. Overstate the value of what you're importing, send the extra money abroad, and you've successfully moved capital out of the country while looking legitimate on paper. The extractive industries are particularly notorious for this. Oil, minerals, precious metals. Africa's most valuable exports are also the easiest to misprice because their value can be subjectively assessed. A mining company can claim low-grade ore when they're actually extracting high-grade materials. An oil company can use complex pricing mechanisms that bear little resemblance to market rates. By the time African governments realize what's happening, the resources are gone and the money has vanished into complex corporate structures spanning multiple jurisdictions. But here's what makes this particularly devastating. This isn't money that belongs to corrupt politicians alone. This is money that should fund schools, hospitals, roads, and infrastructure. Every dollar that leaves through illicit flows is a dollar not invested in African development. It's a teacher not hired, a clinic not built, a road not paved. The capital leak from illicit flows isn't just an accounting problem, it's stealing Africa's future. Point 2. The debt trap. Borrowing money that flows right back out. The second major form of capital leak is more subtle but equally damaging: the debt service trap. African countries borrow money for development, roads, ports, power plants, and then watch helplessly as huge portions of their national budgets are consumed by debt repayment. This wouldn't be a capital leak if the borrowed money stayed in Africa and generated returns. But that's not what happens. Africa's total external debt has exploded in recent decades. surpassing $700 billion. Some countries now spend more on debt service than on healthcare and education combined. Zambia, Ghana, Kenya. These aren't failed states. They're countries that took on debt for development and now find themselves trapped in a cycle where new loans are needed just to service old ones. Here's the capital leak mechanism. African governments borrow money, often at higher interest rates than developed nations because of perceived risk. Much of that borrowed money then goes to foreign contractors, foreign consultants, and imported materials. A Chinese loan for a railway means Chinese companies building it with Chinese materials and Chinese workers. A World Bank loan comes with conditions requiring expensive Western consultants. The money enters African government accounts and exits almost immediately, flowing to foreign entities. Then comes the repayment. Every year, African countries must send billions in interest and principal payments to foreign creditors. This is money extracted from African economies, from taxes on African businesses and workers, and transferred to banks and bondholders in New York, London, Beijing, and Paris. The continent borrows to develop, but ends up in a situation where the debt service itself becomes a major drain on capital, extracting more wealth than the original projects generate. The cruel irony is that this happens even when African governments borrow responsibly. You can have a perfectly legitimate infrastructure project that makes economic sense, but if the implementation siphons money abroad and the debt service becomes unsustainable, it transforms into a capital leak. The infrastructure remains, but the wealth has departed, and future generations are left paying for assets that never generated sufficient returns to justify their cost. Point 3. Profit repatriation, the corporate extraction machine. Now we come to a form of capital leak that's entirely legal, but perhaps most significant in scale: profit repatriation by multinational corporations. When foreign companies operate in Africa, they naturally send profits back to their home countries. This is expected and legal. The problem is the scale and the mechanisms that minimize what Africa retains. Multinational corporations operating in Africa, in mining, telecommunications, banking, manufacturing, generate enormous profits from African markets and African resources. But through legal tax optimization strategies, transfer pricing, and corporate structures, they ensure that the bulk of these profits are recognized in low-tax jurisdictions rather than where they were actually generated. Here's a typical structure. A mining company operates in an African country. The actual mining is done by a local subsidiary, but that subsidiary must buy equipment, technology, and services from related companies in the corporate group at inflated prices. It must pay licensing fees for using the parent company's technology. It must pay management fees to the regional headquarters. By the time all these intra-company transactions are accounted for, the African subsidiary shows minimal profit, so it pays minimal tax. Meanwhile, the real profits appear in Ireland, Luxembourg, or Singapore, where they're taxed at much lower rates or not at all. This is called transfer pricing. And while there are international rules governing it, African tax authorities often lack the resources and expertise to challenge sophisticated multinational tax structures. The companies aren't breaking laws, they're exploiting the gaps between different countries' tax systems. It's legal capital leak, but it's capital leak nonetheless. The scale is enormous. Some estimates suggest that multinational corporations shift over $40 billion in profits out of Africa annually through these mechanisms. That's $40 billion that could be taxed to fund development, but instead flows to shareholders in wealthy countries. African resources extracted by African workers generate profits that build wealth in London, New York, and Shanghai, while African governments struggle to fund basic services. Add to this the straightforward repatriation of dividends. Even when companies do pay appropriate taxes, the after-tax profits leave the continent. A telecom company making billions from African consumers sends those profits to European or Asian parent companies. Those profits get reinvested, but rarely back into Africa. They fund expansion in other markets, reward shareholders abroad, or sit in corporate treasuries. Africa serves as a profit source, but not a profit destination. Point 4. The brain drain. Human capital walking out the door. Capital leak isn't just about money, it's also about people. Africa suffers from a devastating brain drain where its most educated and skilled citizens leave for opportunities abroad. This represents a massive capital leak because African countries invest in educating these individuals, only to see them contribute their productive years to foreign economies. Consider a typical scenario. An African country spends years educating a child through primary school, secondary school, and university, all subsidized by taxpayers or development funds. That student becomes a doctor, engineer, or software developer. Then they migrate to Europe, North America, or the Middle East, where they'll earn more and have better opportunities. Their entire productive career, their skills, their innovations, their economic contribution, now benefits a foreign economy. The African nation paid the education cost, but receives none of the returns. The numbers are staggering. Africa loses an estimated 70,000 skilled professionals annually to emigration. Ethiopia loses over 70% of its trained doctors. Ghana, which invested heavily in medical education, has more Ghanaian doctors practicing in New York City than in rural Ghana. African nurses staff hospitals in Britain, while African hospitals lack basic medical personnel. African software engineers code for Silicon Valley, while African tech sectors struggle for talent. This is capital leak, because education is an investment. When African countries train a doctor, they're investing tens of thousands of dollars in creating human capital. When that doctor leaves permanently, that investment walks out the door, and the returns accrue elsewhere. It's not just the individual's contribution that's lost, it's the multiplier effects. That doctor could have trained other doctors, started a clinic, contributed to medical research relevant to African diseases. Instead, they're treating patients in London or Toronto. The remittances these migrants send back are often cited as a counter-argument. And yes, African diaspora remittances exceed $40 billion annually. But this doesn't compensate for the loss. Remittances are consumption money. They help families survive. But they don't replace the systematic productive contribution of skilled workers embedded in an economy. You can't build an advanced economy on remittances. You need your skilled workers actually working in your economy, starting businesses, mentoring others, and driving innovation. The brain drain also creates a vicious cycle. When the best and brightest leave, the quality of institutions deteriorates, making the country even less attractive to remaining talent. The doctors who stay must work in under-resourced hospitals. The engineers face limited opportunities. This pushes more people toward the exit, accelerating the drain. Africa invests in creating human capital, and the world benefits, except Africa itself. Point 5. The investment paradox. Money that comes with strings attached. Finally, we must address a particularly frustrating form of capital leak: the structure of foreign investment itself. Africa desperately needs investment capital, and it does receive it. Foreign direct investment, FDI, in Africa reached about $45 billion in recent years. But much of this investment is structured in ways that ensure capital flows back out, often exceeding the original investment. Portfolio investment, money flowing into African stock markets and bonds, is notoriously volatile. It comes in when conditions look favorable and flees at the first sign of trouble. This hot money creates boom-bust cycles that destabilize economies. When it flows in, it inflates asset prices and currency values. When it flows out, it crashes markets and drains foreign exchange reserves. The net effect over time can actually be negative, with more money leaving during panic exits than entered during optimistic entries. Even long-term FDI often comes structured as loans or includes aggressive profit repatriation clauses. An infrastructure project might be financed by foreign investment, but the returns are structured to flow abroad. A factory might be built with foreign capital, but the profits are sent back to the parent company, and the technology remains proprietary, preventing local skill development. There's also the issue of investment flowing to sectors that don't generate broad-based development. Much foreign investment goes to extractive industries, oil, gas, mining, that create enclave economies. They generate significant revenue, but employ relatively few people and have limited linkages to the broader economy. The profits flow out, the resources are depleted, and African economies are left with little to show except environmental degradation and economic inequality. The investment paradox is that Africa needs capital, attracts capital, but doesn't retain the benefits of that capital. The money comes in, circulates briefly, generates returns, and those returns, along with often the original capital, flow back out. What should be a wealth-building mechanism becomes another channel for capital leak. So here we are, staring at the fundamental problem. Africa isn't poor because it lacks wealth. It's poor because its wealth keeps leaving. The capital leak problem is why Africa's growth story keeps failing, despite endless potential, despite abundant resources, despite a young and growing population. Illicit financial flows drain away $50 to $80 billion annually. Money stolen through trade mispricing and corruption. Debt service siphons off billions more, with borrowed money flowing immediately to foreign contractors, and then years of repayments flowing to foreign creditors. Multinational corporations extract profits legally but aggressively, using sophisticated structures to minimize African tax revenues. The brain drain costs tens of thousands of skilled professionals annually, taking with them the returns on Africa's educational investments. And investment, rather than building lasting wealth, often creates new channels for capital to flow outward. Add it all up, and you get a devastating picture. By some estimates, Africa experiences a net capital outflow. More money leaves the continent than enters it. We talk about helping Africa develop, about foreign aid and investment, but the fundamental architecture of the global economy is extractive. Africa is running on a treadmill where no matter how fast it runs, it's not moving forward, because the wealth it generates is being extracted at an even faster rate. Breaking this cycle requires fundamental changes. It requires international cooperation to stop illicit flows, transparent corporate structures, fair tax systems, debt relief and restructuring, investment in retaining skilled workers, and development finance that actually stays in Africa. It requires treating Africa not as a source of extraction, but as a partner in shared prosperity. The question isn't whether Africa has the potential for growth. It clearly does. The question is whether the global system will allow Africa to retain the fruits of that growth, or whether the capital leak will continue draining away the continent's future. Until we fix the bucket, it doesn't matter how much we pour in. That's why Africa's growth story keeps failing, and that's what must change.